Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that is absolutely crucial for anyone serious about success in the markets, yet it's often overlooked. We all talk about strategies, indicators, and market analysis, but what about the one tool that can tie it all together and supercharge your growth? I'm talking about your journal, and specifically, how to use it not just for logging trades, but as a dynamic tool to actively refine your risk management strategies over time. Think of your favorite athlete. Do you think they just show up on game day and hope for the best? Of course not. They watch game tapes. They analyze every move, every decision, every mistake. They study their opponents, but more importantly, they study themselves. For a trader, your journal is your game tape. It's the most honest, unfiltered record of your performance. Ignoring it is like an NFL quarterback refusing to watch their last game's footage. You're leaving massive potential for improvement on the table. So, what does this look like in practice? Most traders start a journal, and that's a great first step. They'll write down their entry price, their exit price, maybe a quick note like hit stop loss or took profit, and that's where it ends. This is what I call a passive journal. It's a record, a history book. But we want an active journal, a living document that works for you. To turn your journal into an active risk management tool, you need to go deeper. For every single trade, you should be documenting not just the what, but the why and the how. What was your risk-to-reward ratio before you entered the trade? Why did you choose that specific stop-loss level? Was it based on a technical level like a support or resistance? Or was it just an arbitrary percentage? How did you feel emotionally when you placed the trade? Were you confident, anxious, or were you revenge trading after a loss? These details are gold. They are the data points that will reveal the patterns in your behavior. After a week or a month of diligently logging this information, you can start your review. This is where the magic happens. Don't just glance at your profit and loss. Look for recurring themes. For example, you might notice a pattern. Every time I trade against the main trend, even with a tight stop, I get stopped out 80% of the time. That's not just a bad week. That's a data-driven insight into a flaw in your strategy. The next step is to formulate a hypothesis. My risk management could be improved by avoiding counter-trend trades entirely, or by using a much wider stop loss and smaller position size for them. Now, you have an actionable rule to test. For the next 2 weeks, you consciously apply this new rule. You either stop taking counter-trend trades, or you adjust your risk parameters for them as planned. And you continue to journal meticulously. At the end of that period, you review again. Did your win rate improve? Did your average loss decrease? Did avoiding those trades reduce your overall stress and emotional decision-making? Your journal provides the answer. If the new rule worked, it becomes a permanent part of your risk management plan. If it didn't, you go back to the data, form a new hypothesis, and test again. This is the scientific method applied to your trading. It's an iterative process of observation, hypothesis, testing, and refinement. Let's take another common example, position sizing. Many traders use a fixed lot size for every trade, but in your journal review, you might discover that your highest conviction setups, the ones that align perfectly with your strategy, have a much higher win rate. However, you're risking the same amount on these A+ setups as you are on B or C grade setups that you took out of boredom. The data in your journal screams for a change. Your new hypothesis could be, I will refine my risk by creating a tiered position sizing system. For A+ setups, I will risk 1% of my account. For B grade setups, I'll risk only 0.5%. You then implement this for a few weeks, tracking the results. You're not just guessing. You're making an informed, data-backed decision to allocate your risk capital more intelligently. Your journal is what makes this possible. It moves you from gambling to calculated risk-taking. Another huge area your journal helps with is managing emotional risk. You can literally create a column in your journal for your emotional state, before, during, and after the trade. Maybe you'll notice that after 2 consecutive losses, your third trade is almost always a loser because you enter it impulsively, a classic case of revenge trading. Your journal makes this pattern undeniable. Once you see it in black and white, you can create a rule. After 2 consecutive losing trades, I must step away from the charts for at least 1 hour. I will take a walk, read a book, do anything but trade. This isn't a sign of weakness. It's a professional risk management protocol designed to protect your capital from your own emotional responses. Over time, you might refine this rule further. Maybe you find that the break needs to be longer, or that you need to review your trading plan before you're allowed to trade again. Your journal also helps you refine your stop-loss strategy. Are you constantly getting stopped out just before the price moves in your intended direction? This is a common frustration. By journaling the details, you can analyze why. Maybe your stops are too tight for the instrument's volatility. You can track the average true range ATR of the asset at the time of your trade and note it in your journal. After a few weeks, you might see that setting your stop at 1.5 times the ATR instead of 1 times the ATR would have kept you in many winning trades. This is a concrete, mechanical adjustment to your risk strategy, all thanks to the detailed records you kept. The same goes for profit taking. Are you consistently closing trades too early, leaving a lot of profit on the table? Journal how you feel when a trade is in profit. Do you get anxious and just want to lock it in? Seeing this pattern allows you to experiment with new rules. For example, when a trade reaches a 1-to-1 risk-to-reward ratio, I will move my stop-loss to break even and take off 50% of the position. I will let the remaining 50% run with a trailing stop. Then, you track the performance of this new approach. Does it increase your overall profitability? Does it reduce your anxiety? Your journal will tell you. This process of continuous refinement transforms you from a reactive trader who just takes what the market gives to a proactive risk manager who is constantly adapting and improving. Your risk management plan stops being a static document you wrote once and forgot about. It becomes a living, breathing part of your daily routine, evolving with you as you gain more experience and insight. The key is consistency. This isn't something you do for 1 week and then stop. This is a career-long habit. Your journal becomes your most trusted mentor, your strictest coach, and your most honest critic. It holds you accountable and forces you to confront your weaknesses, not with judgment, but with data. So, I challenge you today. Don't just log your trades. Start a dialogue with your trading self. Ask the tough questions. Why did I take that risk? Was it justified? How did my emotions influence my decision? What pattern am I seeing this week? What one thing can I test next week to improve my risk management? This iterative loop record, review, refine, repeat is the engine of true, sustainable growth in trading. It's how you move from inconsistent results to building a professional, disciplined approach. Your future self will thank you for it. Thanks so much for watching today. I hope this gives you a new perspective on the power of journaling. If you found this helpful, please hit that like button and consider subscribing for more content on building a professional trading mindset. Let me know in the comments how you use your journal to manage risk. I'd love to hear your ideas. Until next time, trade smart and manage your risk.